What's up, folks? Kenneth here, streamhomeloan.com, 100 years of wealth. I hope you guys are all doing well. So, when will this real estate market get better? When will our lives as mortgage loan officers and real estate professionals not be hanging in the balance due to this market, this forced market downturn by the feds, right? So, right now, what we're seeing is that the sales have continued to decline. Not as much as the feds would have hoped or expected, but real estate sales are significantly down. The market is moving at a snail's pace. And the question is, when's it going to get better? What's it going to take for it to get better? For me, the reality of it is that there are so many people that got like homeowners that got rates at below 4%, in the threes, even some below 3%, that those people are out there currently, and a lot of them, or some of them, would sell their property if the rates were better, right? Because a lot of these people are sitting there with a low interest rate and saying, why would I sell this property and move into my next property, whether it's, to retire or downgrade in size or upgrade in size? Why would I make that move right now if I'm going to go from this current home where my rate is at 3%, 3.5%, whatever it is, to a new situation where my rate's going to be 6.5% or 7%? So what that does to the market is it holds off people from selling. People that were going to sell, they say, you know what, I'm going to hold off. So that's twofold. They don't become new buyers for the other property that they were going to purchase, and they don't sell their other or their current property. And it creates a scenario where there is less inventory, keeps prices high, and with high prices and high interest rates, people just don't want to budge. It's like when you think of the concept of a mortgage, it's already a rip, and I don't want to say rip off because of the fact that, like, this is how most people still build wealth. Your property value generally will increase 6 to 10%, depending on the area that you're at. We're in Southern California. We benefit from a large metropolitan area and a globally recognized area. So we have a lot of value here, and generally speaking, most areas throughout Southern California are going to see 6% to 10% increase year over year. Sometimes more, sometimes less, depending on the market. But generally speaking, long term, even though you're almost going to pay double in your mortgage, like if you take out a $300,000 loan, you're going to end up probably paying back close to $600,000 if you look at a 30-year amortization schedule, right? But generally speaking, in that same 30-year period, you probably will see the value of that asset more than double, right? Once again, that rule doesn't apply everywhere, but generally speaking, that's what we've been seeing for a very long time throughout history, or as long as they've been keeping record of purchases, home sales, and value and things like that. So it's just we're in this tight position where people don't want to sell because they don't want to let go of those super low interest rates and go into something much higher, and values are staying high because people don't want to sell, less properties on the market, and it just makes it really tough. And the thing is, a lot of people just don't want to come down on what their sell price is, right? And the reason is because they have, you've built up equity, even if it's like all kind of like pie in the sky until you sell. It's like right now, we have a investment property that we bought for what we feel is a good price, and we locked it in at a very low interest rate while we were still living there as a primary residence. And then, things change in our plans, and we ended up moving later on. But we have a really low interest rate on that property. There is some equity in the property, but the value's kind of dipped a little bit in the last year or so since the market's been going through what it's been going through. So my point is that even though we have a good equity position there, and unless people are in a desperate need for cash, which comes when there's like a big lots of layoffs and job issues, unless people are in a desperate need for cash, they're not going to sell those properties when in a down market. Values are lower right now than they were a year ago. Values have softened in most areas. So unless people are really urgently needing that cash, they're just going to say, okay, you know what, I have a renter covering that payment right now, or I think that in a short in the short term future, I could probably see the property value a little bit higher once the market adjusts, because we're all kind of sitting back waiting for this adjustment. It's going to make it to where people are not likely to put those properties on the market in a down market. And so it's one of those things. All the economy all works together, right? So if we end up in a scenario where you have tons of job loss, kind of like the 2008 thing, that's what would bring on a scenario where most people are like, hey, look, I'm okay with taking this lower sell price, and getting out of the property and making whatever cash at that time because it's needed. But right now, it seems like the job market's still strong. Consumers still seem to have cash. So you don't see those desperate sales of property where the market's just dipping because of that. Values are still kind of holding true, even though they've softened in the last year or so since rates are higher. But there's just so many factors that are making it to where you're probably not going to see property values drop a lot. And the thing that's going to have to change to get back to a normal real estate market is interest rates. You know what I mean? Like we're too far along into property values getting to where they're at. This isn't 25 years ago, or 20 years ago in 2000 or 2003 or so, where property values were a lot lower. And even then it was already high. I don't even think that market could really sustain higher rates, 7-8% for too long. So it's like, we've our whole economy became accustomed to a lower interest rate market. And I don't think that lower interest rate market is what created the inflation. It was the backup of the supply chain. It was the influx of dollars being introduced into the economy by the feds. It was a bunch of different factors, but it wasn't the low interest rate market, at least in my humble perspective. So to wrap this up, do me a favor before we wrap it up, like and subscribe. But my main point is just that in order for the real estate market to get back to normal, it's going to take interest rates to drop, right? The payment scenario for, let's say just an equal comparison or a very similar comparison, because I went through this scenario not too long ago. When we refinanced our property, that ended up later on turning into an investment property. But while we were still living there and we refinanced, we were able to get the payment, including property taxes and insurance, right at about $4,000 a month for I think it's like a $720,000 loan or something like that. That's including the taxes and insurance. That rate was in the threes, or if not right at 3%. The same exact loan, same loan amount, but today's market would be an interest rate of probably 6.5%. And this is just guessing because I don't have my calculator, but that would likely bring the payment up. Let's see, the scenario I just ran yesterday was a payment of around $6,200 on an interest rate of around 7%. Private mortgage insurance was high on that one. But yeah, you're looking at almost a $2,200 payment difference, depending on some factors. Actually, that includes private mortgage insurance, the scenario that I ran yesterday. But I would say you're probably looking at a $1,500 payment increase based on the interest rate difference. So that by itself, that increase in rates by itself disqualifies a bunch of people that could have qualified at the lower interest rate. And then also it's just the mind state of how much higher that payment is for a lot of people. It's just like, hell no. So point being is that in order for our real estate market and our mortgage market to get back to some sort of normalcy, we got to see rates drop down. And my thoughts are that rates need to drop down at least to where the going 30-year fixed rate is closer to, the high 5% range. I think if we do that, I think more people are going to see that as like, hey, rates are good. They're probably not going to return back to the threes, low fours for a long time, unless there's some crazy things that happen in the economy. But I think a lot of people would be like, okay, hey, that is enough of an incentive to get me back to, chasing that dream of purchasing a home, if that was in their plan. So at the end of the day, like and subscribe. I appreciate you checking in. Comment, question. We got to get these rates down. Let's go, Jerome Powell. Come on, Feds. I think that the next meeting, everyone is speculating that they're going to put a pause on raising interest rates. I'm not so sure. I feel like Jerome Powell he wants to stick exactly to what he was saying. I think that they see the inflation is coming down, and they don't think it's coming down fast enough. They don't think it's slowed the employment market enough, and it hasn't slowed consumer spending enough to to tell them that they should stop hiking rates. So I could be wrong. I feel like a lot of the stock dudes that are out there saying, no, they're going to stop raising rates, they're a little optimistic. I don't have much money in the stock market. I don't really believe in the stock market so much, right? Like, I'm not going to debate on that right now, but I'm not like completely sold on that's where I should put all my money or put a lot of funds, right? I'm more of a real estate market person. But I feel like a lot of those people are speaking from like a perspective of optimism because they're vested in that. For me, I'm thinking Jerome Powell is probably going to stick to what he said, and definitely not lowering rates in this year. But from what I've heard from all the different Fed chairs, the Atlanta Fed chair, the Texas Fed chair, or I don't know if chair is the right word, but the people that are, part of the Federal Reserve that are in these different states, it all sounds to me that they're going to raise rates again. And they're trying to see if they could raise it again and almost break things without breaking it. So let's see. Let's check back in a few weeks when the time comes again for them to have that meeting and announce if they're raising rates or not. My bet is I'm gonna say they're gonna go up a quarter. I think they're going to go up one more quarter, possibly another quarter. I just don't feel like the economy has been shaken enough for them. They want to see like things kind of like not like go full blown recession, but they want to see companies stop hiring for a moment, which to me is like the whole way that they're going about trying to battle inflation. To me is just like, that's like kind of like trying to battle gangs by arresting gang members. Think about that. What I mean by that is like there's a root problem with both situations. If you try to hit it on the end, you're just going to keep battling the end and like be surprised when something new pops up, as opposed to, hey, what's the root problem with gang culture? It's probably poverty. It's probably lack of access to resources, things like that. So if you hit it with the front end, you're gonna have less people that could even be susceptible to stumbling into that lifestyle, right? Inflation, if companies in this country are profitable during a time where inflation is going, there's something wrong with that. You know what I mean? Like that just seems crazy to me. It seems like if you could apply some sort of regulation to the side of corporate profits, and I'm not trying to hold back capitalism, but I'm just saying like you should, like, if your consumer base is saying, ouch, this is hurting, like this is killing us, and your company's profiting more than it's ever profited before, it should tell you that you guys are probably the cause of the inflation or a big cause of it, or you know what I'm saying? There's like there should be a different approach, I think, but we'll see. And I guess you have to really think of like, what's the Fed's mandate? They're not part of the government, all this different type of stuff to really kind of be more accurate on that. But just from a layman's perspective, I'm like, you guys are hitting it from the back end, you're hitting it from the back. Like and subscribe. 100 Years of Wealth. I hope everything is great with you. Share this with anyone that has any, interest in mortgage, real estate, monetary, whatever, so that they can comment, give me some information. We're all here to learn and grow. So thanks for tapping in. Peace. Yo, hey, wait a minute. Go Lakers. We got Denver on this one.